I did the notes for you. Alright, so can you come to class, can you log into your computers, please? Can you log in?
This Thursday, or we can meet online. Google has the Google conference room and just speak.
Yeah, we can do that, I guess.
So can you tell me what the Dow did? What's going on, Mark?
It is up.
Yell it out.
It is up 138.18.
Great to what?
Let's go.
To 25,995.
Okay. Any news? Any reason why? Nothing? Market just goes up 125 points just for the heck of it.
It says Nike gets a boost.
Yeah, Nike
Well, Tesla's actually dropping.
Nike stock grows.
It went up? Nike stock went up? Okay.
It says Microsoft is really strong too.
Okay. We're getting into September, right? At the end of September, there's going to be a lot of earnings releases that are going to come out, that are going to move the markets. Don't raise your hand, just yell it.
So Apple's up.
Because there's a new iPhone being released.
Which one?
Apple's up because there's a new iPhone being released.
Okay, perfect. Does Apple make up a significant portion of those stock indexes, particularly NASDAQ and S&P 500? Yeah, how big is that company? Over how much? $1 trillion. Market cap, $1 trillion. What about Amazon?
Catching up.
What's Amazon? How big is Amazon?
About They're pretty close to each other.
Yeah, about $1 trillion. Yes. So do you think that the stock indexes are going to move up and down if
They go up.
they go up? Yeah, they're going to move the markets. So you want to be looking at the markets. What about oil? I'm concerned. I'm worried. I'm worried about oil.
Oil
What's the
is
barrel of oil trading at right now?
Oil is at 69.23.
What is it?
69.23.
69. It's off. It was trading what, around 70? 70?
I think so. No, I think wasn't the last time like 78 or like.
Where is it now? I mean, is it trending up or down? This is a big deal because there's geopolitical risk. We got
Currently
a
going
major, military offensive going on in Syria, which is basically creating major instability in the Middle East. And if Iran gets involved, which it already is, along with Russia, there could be disruption to the supply chains coming out of the Straits of Hormuz. Okay. So is oil up or down?
It's up, so that should be.
Slightly up.
Let's see going down.
And the employment numbers came out on Friday. Employment numbers came out. Do you know what the job numbers were? The unemployment rate, do you care? Yeah, you do.
3.9%.
Yeah, and then we had over 200,000. And then wages were also reported too. They were up, over 3%. Okay, the Fed's going to be concerned about inflation. You have rising wages, low unemployment, super hot job market, major investment, CapEx expenditures going on, by major corporations. This is all big news. Where's gold trading right now per ounce?
Gold is currently at 1,202.10.
And is it up or down?
Up.
It's up. And if wages are going up and inflation is going up, where do you think oil prices are going to go?
Up.
Is oil prices, gold prices, are they correlated to the inflation rate?
Yeah.
Yes. Okay, you guys are doing good. Where's the current 10-year bond yield right now? What is it?
2.976.
2.976. So the yield is down?
Slightly up.
Up? Okay. So if you're using the Fisher equation, if the bond yield is up, what could be driving bond yields up? Using the Fisher equation, do you take any notes? You can always look at your notes. If you don't remember, you can always take a note if you took notes. Some students don't take notes, so photographic memory is at least don't remember these things. So what would be driving bond yields up using the Fisher equation? What? Bond yields are interest.
Inflation expectation?
Got it. Okay, that could be one reason. What else would drive bond yields up? Are people buying or selling bonds if bond yields are going up? Are they buying or selling bonds if bond yields are going up? Are they buying bonds or selling bonds if bond yields are going up? Bond yields and prices move in the same direction or opposite direction? Opposite direction. So if bond yields are going up, bond prices are going down. If bond prices are going down, are people selling or buying bonds? Selling bonds. So if bond yields are going up, are people buying or selling bonds? If bond yields are going up, are bond prices going up or down? Down. If bond prices are going down, then bond yields are going. If bond prices are going down, then bond yields are going up. Okay, you got to memorize this stuff. Okay, you can't be wrong on this stuff. Okay, so if bond yields are going up, then bond prices are going down. If bond prices are going down, are people buying or selling bonds? Selling. Got it. Okay. This is the law of economics. Okay. Where's the dollar to the pound? Right now? Dollar to the pound, dollar to the euro. Is it up or down? You need to all be on your computers and looking at this stuff. I see people just hanging out, you know, letting everybody else do the work. What is it? Slightly up, so it costs us more to buy a pound? Okay, if it costs us more, did the dollar appreciate or depreciate? If it costs us more to buy a pound, did the dollar appreciate or depreciate? Appreciated. Did the pound appreciate or depreciate? Appreciate. Got it. You guys are good. This is it. We're going to go over this over and over again. Okay, because you got to understand this stuff. All right, excellent. I do have copies of the extra copies of the extra credit problem set. Anybody wants it? Okay, no interest?
Yeah.
Got it. Okay, here you go. So right now. Got it. Any questions on the pretest? Okay. The homework, you're going to need to do a cover page for the homework. Okay. Can you make sure that the camera's on the while I'm putting up the diagram? So you're going to do 2 cover pages. Do 1 cover page for the homework, 1 cover page for the deliverable package. Okay, which you're going to submit. Now the homework cover page, you put your college, the course, section, top, bold, 16 point, bold. Number 1, I would probably put that in 22 point type. And it's going to be 2, make, from, you, and then the full date. That's going to be the cover page. Then you're going to tack on the back, you're going to staple on the back the handwritten homeworks. Okay. Got it. Quiz 1 review. Let's see. Before we go into the review, I basically printed out my notes. In the class, you probably already also took pictures of these, but I thought I'd provide them to you. There's the notes for the dynamic supply demand analysis. Here are the notes to the financial product development and innovation. Didn't we already go over that? Yes? No? Yes? No? Yes, we went over that in class. So I basically gave you the notes. Do you want me to continue to give you the notes? You want the notes? Okay. And then what are we going to do today? Oh, I'm going to do a review session. You can also review the videos. I'm going to do a review session on Sunday, September 23rd from 11 to 1. Okay, in GD 220, 2 hours. We'll go over the exam. Go over the exam, go over the exam. You come in on Tuesday. You put everything away. You start writing in a new blue book in the new exam that I'm going to give you. You see what you remember, and then you get off. You go study Tuesday night. Sorry, you go study all day Monday. Come in on Tuesday. Study Tuesday morning, take the exam, Tuesday afternoon, go study the exam, study all day Wednesday, study Thursday morning, come in, I'll give you back the exam, you finish the exam.
And the review was 11 to 1 on Sunday.
That's correct, the
eight-
23rd,
The 23rd.
and
and
JV 220.
JV 220. Okay.
Okay, all right, so plenty of opportunities, it's also a test. Not only is the exam and a test, in which you learn, but did you study? Okay, and usually most of the people ace the exam, because they do really, really well because they study. People who don't do well on the exam, you're gonna have to go back and do it again. Okay, and you'll do it again until you get it right. We already did market updates, any questions on the pre-test? No? Let me see your memos, hold up your memos, so you can take a look at them. Does anybody read the syllabus?
I thought you told someone was due Thursday when I asked you
Yeah,
about
but I wanna
it.
look at it and see if anybody did them, or just check them. The memo needs to be in capitalization, and needs to be better.
Hold on.
That looks pretty good, we just wanna talk to
No,
these.
someone did it.
Anybody else do the memos? Make it a type test?
Someone had it.
Okay, so let me see.
It's not due today.
You can always print it out over here. Memo, will you bring me one on Thursday? What? No, why don't you talk to me? I'm right here. Okay, yeah, show it to me on Thursday. I'm just checking this stuff, to see if you get it. And then I'm just putting a little pressure on you to get it done. Because, people procrastinate, and if I put a little pressure on you, you get it done, at least you bring me something, so. Anybody else make an attempt? No? So can you guys bring me a draft on Thursday?
Sure, I thought you said you were going to talk about today, though, last week when I asked you about it. Like,
Huh?
I thought you said you were going to talk about the memos today, that's about last week, Thursday.
Oh, did I go over the memos?
No, I think you haven't. Partially. That's why.
This is just a test to see if you can even do it. Just do it. Okay? It's an attempt to see if you just attempt to do it. Now, where are the exams? I mean, the memos? Anybody need a copy of the memos? You need a copy of the memos?
No, it doesn't matter.
Okay, let's go over it again. And I'm gonna go over the trades in class, and I'm gonna do some stuff. Okay, so here's the memo. You want it to look exactly like this. The first assignment for this thing was just to replicate the memo, just to see if you can do it. You can replicate it. If you wanna go one step further, which you do is you update the data. Okay? So you can just replicate this memo, if you know how to put together a memo. You replicate the memo. Stock prices are gonna go up. I don't care if it's 3%, 5%, 8%, 10%, you can use whatever you want, they're just gonna go up. We are tracking stock prices, that doesn't change. Based on our research, we forecast stock prices to rise by whatever amount you want, nothing more than 10%. Okay? The rest of the sentence stays the same. Gains in the Dow Jones, S&P, and NASDAQ, that's not very good. It should be upward trend. Upward trend in major stock market indexes. I would start taking some notes. Comma, wage growth. I wouldn't capitalize the W or the G. You could have said rising gross domestic product, rising production, falling unemployment, higher earnings expectations. You could use any of those factors. You could use the same factors that we went over in class when we did the dynamic supply demand analysis. Or if you're reading articles in and around the stock market and the movements, they're going to tell you within the articles what are driving this, what's driving the stock market up or down. And it's either earnings expectations or interest rates. They're the two major factors driving them up and down. And low inflation, period. Therefore, same thing. We recommend following 36 trades, doesn't change. The trades and the indices don't change. The trades don't change. If you want to go out and find some exchange traded funds, do some research, find some of those. You could put those in there, put the tickers in. You could pick any 5 stocks, put the tickers in. The 12, the 9, the 15 doesn't change. The 36 doesn't change. In the past 9 months, the Dow Jones Industrial Average gained 280%. The Standard & Poor's Index gained 312%, and NASDAQ gained 496%. That's the analysis. I'm looking for that data. If you can't do the research, and you don't know how to do the research, just copy the stuff, put it in so that you have a template that you can work with, and then go back and update it. Okay, you're making it harder than it is. Okay, at this point, I want to see if you know how to format a memo. Okay, so then you put in the data. If you read the articles, it's going to give you the information. you put the information in there. You can go to stockcharts.com or bigcharts.com, go back 3 years, you can copy and paste the graphs in there. You may also want to do a text box and copy and paste the graphs into a text box so you can size them so that they fit here. The graphs are the hardest part of this memo, okay? It's the hardest part of the memo. If you've never done formatting before, it's the hardest part of the memo. Do you think you're going to be formatting content when you go work for somebody? Is it going to be easy? If you've done it before, it's a lot easier. If you're not comfortable with it, it's going to be really hard. Okay? And then basically the paragraph down here is the introductory paragraph. So the only thing that changes is the following changes to above and the semicolon changes to a period. That's it. If you think the market's going to fall, then go to the template where use oil prices but change it. Oh, here we go. I got it right there. Gabe already did one. Gabe Velasco. He did a stock price memo for you where he was forecasting the prices of the indexes, the ETFs, and the stocks to go down, and laid out the trades for you there too. The memos, I was just checking to see if you I'm trying to push you because people procrastinate on these things and they don't take them seriously. I get at least 5 people every semester that are in my office crying because they didn't go over the memos with me during the semester. They waited till the last minute. They didn't even come see me once. And then they want me to redo their memo form, and it usually takes at least 6 weeks. Constant input and guidance and sitting down and making sure that this is perfect. It takes like 6 weeks to get these things down. By the end of the semester, they'll be perfect, and you'll totally get it. Okay? But you gotta work with me. If you're scared of working with me, you gotta get over that. Okay? You're gonna be working with people like me when you get out of here. Okay? On a daily basis, constantly. Okay? And we're here to help you. All right, so Ian, do I need to do any more on the memos? Okay, you can, the top and the bottom spacing is not a big deal. Make sure you have 1-inch margins on each side. Okay? And then what I do is I tighten up the top a little bit, so I have a little space at the bottom, because what we like to do is write notes at the bottom of these memos. Okay? And since I read these things like 500 times, because I have 3 classes, 30 students, 5 memos, and I review them. I'm reviewing them like 500. I do like 500 of these things. So the format's really important, that I can scan it, check it, and give you some constructive feedback, get a good solid template together so you can replicate it for the other memos. And then you staple them together at the end of the semester in color, and you can hand them out to people as writing samples. And they do get people jobs. I've already had 2 students get jobs. One as an oil analyst, and one as an equity analyst. Do you know anything about stocks? Boom. Do you know anything about oil? Boom. They got the jobs. So did you write this? Yeah, I wrote this. Get it? So we did financial product process innovation. We need to go over that. It's a capstone. Okay? It's a capstone lecture. There's no difference between financial institutions, private equity firms, hedge funds, broker-dealers, large banks, fintech companies. They all adhere to this process here that we went over in class. This is exactly what they go through. Same thing with Apple, same thing with SAP, same thing with Salesforce, same thing with Oracle. This is the standard approach to creating an innovative environment for product development and ideas. Okay? And if you can do that, if you can bring creativity, new product ideas to the marketplace and work within the firm, you're going to get the bonuses, you're going to get the promotions, you're going to get everything. Okay? And if they don't give it to you, then you leave. And you take it someplace else. Either you do your own startup or you take it to another company who will buy you. Okay. All right, modern portfolio theory. Okay. If I'm constructing a company, I'm building a company, an enterprise with multiple divisional lines and multiple product lines. Do I want the cash flows of those divisional lines to all be positively correlated with each other? Do I want them to be positively correlated? Or do I want, in some cases, low, no, and negative correlation in the cash flows amongst the mix of products that I have within the company?
What mix?
But
Mix.
I want to have a mix, and do I want to have the cash flows positively or negatively correlated with each other?
Negative.
But
Negative.
negatively, right? So you want to create a diversified line of products across different product lines whose cash flows aren't correlated with each other, because if the cash flows all go down, what happens to the company? It goes down too. So you have to be extremely creative and create a diversified product line. It's the same thing with portfolios. When I'm building a portfolio for my clients, I want to create diversification within the portfolio. So either I can create diversification by adding different asset classes to the portfolio, or I can add assets to the portfolio whose returns have no lower negative correlation with each other. Okay. So I'm going to go over here. I've already written it up on the board. So I would take the notes and I could just walk you through the process. So this is modern portfolio paper. Hopefully my camera over there.
Yeah, maybe a little bit.
Here, I'll just check it out.
But you
Okay.
listen up a little bit. How's that look?
Adjust.
Pretty good?
That's good.
Okay, good. All right, so you want to draw these out in your book. Okay, draw these out in your book as I go through. So this is modern and postmodern portfolio theory. So I've been hired to basically put together a portfolio of stocks and bonds for my client. This is the theoretical underpinning of the portfolio construction process. So the first, on the y-axis, you're going to have the expected return on the portfolio. Okay. On the y-axis, the expected return on the portfolio. On the x-axis, you're going to have the portfolio standard deviation. And when I say portfolio standard deviation, what comes to mind? It's the first thing that comes to mind. Risk. Risk, exactly. Risk. So it's a return risk. Okay, continuum. Then what I would do, this is the way I would draw it out. Then draw out the capital allocation line first. Draw out the capital allocation line. Make sure the capital allocation line goes to the origin and put the risk-free rate. Risk-free rate, capital allocation. Put that in first. Put CAL in capital allocation. Then the next thing you got to do, and this is the way I would draw it out. If you don't draw it out this way, you're going to mess it up on the exam. Okay. Then go right here. Then this is the way I would do it. And then go right out like that. And then go down like this. And then go like this. And then put dots here, 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 and there, and there, here, there. And then put dots in the middle. So every dot along the efficient frontier and every dot in the efficient frontier is a portfolio that I can construct, okay? By using assets in the capital markets. By using stocks and bonds, I can pull together and I can construct a feasible portfolio. So these are all feasible portfolios. Okay. Out here, you're going to have 100% stocks. Over here, you're going to have 100% bonds. So this is a 100% stock portfolio. This is a 100% bond portfolio. The 100% stock portfolio is going to have high risk, but you're also going to get high return. I think this is probably the hardest, one of the hardest problems on the exam, because I'm looking for detail. Okay. Then the bond portfolio obviously is going to have less risk, but significantly less return. Let's say I'm an investor, and I want higher return, and I'm willing to take on more risk. Well, what I can do is I can sell off my bonds and start allocating more of my portfolio to stocks, and I can move out the efficient frontier. If I want to take less risk and I'm willing to get less return, I can sell off my stocks and I can start buying bonds and increasing my allocation to bonds. Okay. These right here, these curves, these are called utility curves. Utility curves. These are utility curves for you as an investor. Okay. Now, you want to be out here, don't you? High return, low risk. Well, unfortunately, there's no portfolios that I can construct in the markets that are going to give you high return, low risk. If I can do it, I wouldn't be here. Okay. I'd be selling my portfolio strategies to somebody else making billions of dollars. So what investors have to do is they have to lower their utilities. Okay? They have to lower their utilities to the point where the utility curve is tangent to the capital allocation line and tangent to the efficient frontier. That point of tangency is what is called the market basket. That is the market basket. Where the utility curve, capital allocation line, and the efficient frontier are tangent, that is the market allocation. That is the market basket. And I'll get into that in a little bit. So at this market basket, this is the point in which the expected return on the portfolio is at its highest for the given level of risk. So at that point, I am maximizing the risk-adjusted rate of return of the portfolio. These market baskets are also considered indexes. They're like an index fund. It just replicates the market. So I can buy an ETF or a mutual fund. I can buy an index. Okay, that represents the market. We just replicate the market weights. What I can also do as an investor, if I want to take on more risk, if I'm comfortable taking on more risk, but I really want high return, what I can do is I can leverage my portfolio. I can leverage my real estate. I can leverage my stocks. I can borrow on margin from the brokerage firm. I can borrow money from the brokerage firm and buy more. So I only have $100,000 to buy stocks. I borrow from the brokerage, $100,000. Now I can buy $200,000. If I'm right, and I think that stocks are going to go up and they go up, and I got $200,000 of stock instead of $100,000 of stock, am I going to make more? Yeah, I'm going to make more money. The problem is if I margin the account and the values actually go down, they go down exponentially. They go up exponentially, they go down exponentially because I'm using leverage. So if I apply leverage to this model, what I can do is I can actually jump off the efficient frontier. I can jump off the efficient frontier and I can move up the capital allocation line. I'm going to get significantly higher return, but I'm also taking on significantly higher risk. So I can do that too. If I'm a risk-averse investor and I want to lower risk and I don't mind taking lower return, I can actually jump off the efficient frontier down here, and through the process of lending, I can move down the capital allocation line through the process of lending. I'm going to get low return, but I'm getting significantly less risk in the process. That's what banks do. Banks lend to business owners, they lend to real estate owners, they lend to stock owners, and the business, the real estate, and the stocks are collateral for loans. So if you default on the loans, particularly the real estate loans or the stock loans, if you default, they will foreclose on your property and they will take it. If you don't have enough margin or enough equity in your margin account, because the stock prices went down, you will get a margin call, and if you don't put up the money, they will liquidate your securities to pay back down. So you can move up the efficient frontier, down the efficient frontier, you can jump off the efficient frontier, move up and down through leverage, or through the process of lending. Let's take a look at the market basket. What is the composition of the market basket? Well, between 1920 and 1970, when I was building portfolios around the Great Depression, I had clients coming to me, pension funds and individual clients coming to me and saying, Larry, will you put together a portfolio, a multi-asset portfolio strategy for me? So I said, okay, so we'll put, of your portfolio, we'll have 70% in bonds and 30% in stock. So for decades, the market basket was 70% bonds, 30% stocks. Then in the 1980s, Congress passed legislation called ERISA that basically mandated that pension plans, public and private, should have real estate allocated to their stock bond portfolio. And that, the company, Ibbotson and Associates, basically did the research, the optimization and the portfolio strategy did the research and said that pension funds should have at least 10% of their portfolio allocated to real estate, because the market was so big, for one, and two, real estate returns had low, no, or negative correlation with stocks and bond returns. So by adding an alternative asset to your stock bond portfolio whose returns had low, no, and negative correlation, they benefited through diversification. So then real estate became institutionalized starting in the 80s. Then between 1990 and 2010, Ibbotson did some more research, basically came up with a recommendation, showed the research, and came up with a recommendation to have at least 10% of your portfolio allocated to cash value life insurance. And the banks basically saw this and started to take out life insurance policies, permanent life insurance policies on their senior executives, funding these life insurance policies, building cash value, which basically became what is called Tier 1 liquidity, liquid capital for the bank's balance sheet. So insurance became a part of the allocation for the market basket. And then in 2010 through 2018, Deutsche Bank Reef did some research and came out with a recommendation that pension funds and individuals should have at least 10% of their portfolio allocation in alternative renewable energy assets. And this market is continuing to emerge, and after yesterday's announcement by Governor Brown, so that by 2045, 100% of our energy is going to be sourced from alternative renewable energy, this is a correct allocation. Okay. So this is your target allocation for the next 40 years.
What would be
Yes.
an example of an alternative renewable energy asset?
This would be, if you can, okay, there's two vehicles, okay? You can invest in these assets through publicly traded companies, publicly traded securities, or you can buy private securities, private placements, and you can maybe even participate if you're a pension fund in the actual acquisition or building of these utilities, these assets. Alternative renewable energy classifications would be wind, geothermal, biogas, solar, and then there's one that's called community choice aggregation, or CAA, which are basically utilities that are set up by counties to source alternative renewable energy to meet their renewable energy mandates. So those are the 5 ways you can gain exposure to this asset class, but it's not fully developed yet. It's still emerging. But the insurance is already established, and the real estate's already established, and stocks and bonds obviously are established. And when we were adding these alternative assets, when we're adding these alternative assets to the stock bond portfolio, we were taking directly from the bonds. Because these alternative assets have the bond-like characteristics. Okay? And their cash flows are very stable, and the terminal values on the end are stable also. So you're adding stability to two very volatile asset classes within the portfolio. So this is your target allocation. Okay? And this is the market. This is the market basket. So here's the key. This is extremely important. You need to have this on the exam because this is the first thing I look at, okay, when I look at your exam. Okay, I look at all this stuff and how much detail you have, but this is the part that I really look at. So when I add these asset classes, these alternative assets to my stock bond portfolio, this is what happens. Because the returns on those asset classes have low, no, and negative correlation with stock bond returns, what actually happens is the efficient frontier bows out. The efficient frontier bows out. And it reduces the expected return on the portfolio. It reduces the portfolio standard deviation of the risk within the portfolio significantly more. So if I add alternative assets to my stock bond portfolio, my expected return on the portfolio is going to drop, but the risk of my portfolio is going to drop even more. So what happens to my risk-adjusted rates of return? They go up. And if I can give my clients, and I was listening to the person who was managing CalPERS. CalPERS portfolio is like $1 trillion. It's the biggest pension plan sponsor in the world. He was talking about return expectations. He said, well, we would be happy to get a 7% rate of return on our portfolios on an ongoing basis to meet our pension liabilities in 10, 20, 30, 40 years from now. If I can construct a portfolio and I can get my clients 8 to 10% rate of return constantly over time, if I can get them an expected return of 8 to 10% each year forever going forward, how long will it take for me to double the portfolio size? So 72 divided by 8, rule of 72. Well, let's just do, what? What is it? 9 years. So if I can get an 8 to 10% rate of return on the portfolio for my client, I can double their portfolio size in less than 10 years. That's what they want. That's it. If you can do that, you win. You're going to get billions of dollars invested in your fund. Money will come to you if you can do it. And then you'll have billions of dollars under management. Stocks, bonds, real estate, you name it. So if you can get an 8 to 10% expected rate of return on the portfolio, and you can lower portfolio standard deviation through diversification into alternatives, you're going to increase the risk-adjusted rate of return on the portfolio, or the unit of return per unit of risk, and that's it. You win. Okay. All right, so here's the other thing. What happens if we're going to go into a recession in the next 24 months? What's going to happen to the value of my stocks? What's going to happen to the value of my real estate? What's going to happen to the value of the alternative renewable energy prices? Probably go down too. So am I happy when the prices go down, my returns go down? No. So what I can do as an investor, or me as a manager, to protect from the downside due to market risk, I can also bow out the efficient frontier and hedge off the market risk through the applications of the derivatives, through the derivatives that you're learning about. So I can engineer a bowing out of the efficient frontier by applying the derivative contracts as portfolio insurance through financial engineering. I can engineer it. I can do that too. And that's what I'm going to do, because I'm a fiduciary. I have the responsibility. If I think the markets are going to go down, I can't just have these portfolios be naked to the market risks I have to apply these derivative contracts as prudent standard applications in risk management to hedge off market risk that could destroy the returns and the value of my client's portfolio. Okay, any questions on modern? Modern portfolio theory is applying the alternative assets to the stock bond portfolio and bowing out the efficient frontier. Postmodern portfolio theory is applying the derivative contracts and the portfolio insurance to the portfolio to hedge off the market risk. Okay. So let's go through any questions on that. So the more detail you have on that, the better. Oh, I forgot something. That's really important to me. I also manage very large portfolios for high net worth individuals, women, men, that have companies that they run. They have huge portfolios that they've accumulated in real estate and stocks and bonds and ETFs. They sit on multiple nonprofit boards, and they also are leaders within their companies. If something was to happen to any one of these individuals, the company would probably be impaired, could be destroyed. Definitely the portfolios could be adversely affected. So the way to hedge off mortality risk for people of that stature is you have to apply life insurance. So I have a client with $25 million in net worth. I'm going to get $5 million at least in life insurance to protect the portfolio and to protect the human capital that she's accumulated over the last 25, 30 years, and to be able to bridge the gap with the nonprofits in his company to inject some liquidity to make sure that they can find other people to replace him or her without impairing the ongoing concern itself. So here's the amazing thing about life insurance, is if you apply the life insurance, the premiums will also reduce the expected returns. They will also bow out the efficient frontier because the returns on these life insurance policies are extremely stable. And when the principal does pass away, the estate is injected with the death benefit that will jack the returns on the portfolio, and actually the beneficiaries and the people who inherit and other stakeholders around the operations of the portfolio will move up onto a higher utility curve. Isn't that where we wanted to be originally? It was on a higher utility curve, higher return at a given level of risk. So the only way that you can do that by jumping onto a higher utility curve is through the prudent application of life insurance for the beneficiaries. Okay, any questions on that? So I'm going to be looking for the bowing out of the efficient frontier and the jacking of the returns onto the higher utility curve for the beneficiaries. So the more detail you have of this, the better. And if you can't add the details in there, then I'll probably review your diagrams, and then I'll get it back to you to add more detail to it, because I want you to learn this. All right. So the next are the derivative trades. Okay, and this flows right into your memos. Right? There's only two sets of derivative trades. When prices go up and when prices go down, that's it. Okay. And the last class did a lot of the work for you, so you don't have to do a lot of the work. So if you know anybody in the last class, you can thank them. And what we're going to be trading and tracking, which you're going to do in your memos, is you're trading and tracking three indices. Okay? And you're trading and tracking exchange-traded funds. Do you guys know what an exchange-traded fund is? Do you know what an exchange-traded fund is? No? An exchange-traded fund, or an ETF, is basically a portfolio of stocks that are packaged together, and the portfolio itself trades as a security on the exchange. Okay? The problem is 10 years ago, 15 years ago, if I wanted to buy a portfolio of stocks, I either had to build it myself or I had to buy a mutual fund, okay, a mutual fund share. Now the problem with the mutual fund share is they're extremely illiquid, the fees are really high, and the net asset values of the fund were priced at the end of every trading day. Okay? And people said, no, I want the same portfolio strategy, but what I want is I want to share in that portfolio, and I want it to trade on an exchange, minute by minute, second by second, just like a stock. Because I want to be able to buy calls, buy puts, write calls, write puts on a wide margin. I want to be able to short these things. I can't do that with mutual funds, but I can do it with exchange traded funds or ETFs. And that's what BlackRock did. You know, on Howard Street in San Francisco, Howard and Second, and now they are the largest, one of the largest financial institutions with over $2 trillion in assets under management, because they invented the product. They invented the ETF. Okay? And we all know what stocks are, right? Okay? So if I think you've done the forecast, and you think you think prices are going to go up, these are the trades that you're going to make. And they need to be exactly this in your memo. Don't deviate from it. Use exactly the same words and in the same order. Okay? So you're going to buy forward contracts, you're going to buy futures, you're going to buy calls on futures, and you're going to write puts on futures. You're tracking and trading 3 indices, 4 trades, a total of 12 trades that I could recommend my client. We're also tracking, trading 3 exchange traded funds. Well, if I think the prices are going to go up, I can buy these shares on margin, I can buy call options, and I can write put options, buy calls and write puts. And again, you need to just memorize this. For a total of 9 trades. And then for the stocks, we're tracking and trading 5 stocks. You can, and the stocks are the same thing. Okay, the stocks and the ETF trades are exactly the same. So you're going to buy a margin, buy calls, write puts. 5 times 3 is 15, for a total of 36 trades. So if I think that the prices, stock prices, oil prices, gold prices, bond prices, the value of securities, if I think they're going to go up, these are the 36 trades that I can recommend my client to profit from that forecast, from your forecast. If I think that the values or the prices are going to go down, these are the sets of trades. So if I think prices are going to go down, and these are the trades that are the tools to apply the portfolio insurance to hedge off the market risk of the assets that are in my portfolio. So what I'm going to do is on the indices, I'm going to write forwards, I'm going to write futures, I'm going to write calls on futures, and I'm going to buy puts on futures. We go through these derivatives in chapter 22. Usually people just skip over them. But these are standards that are used in all corporations, in all portfolios to hedge off risk. So why would you put it at the end of the chapter, end of the book, and most professors would just skip over it? We got to be talking about this stuff right up front so that by the end of the semester, you guys totally got it down, you know what the trades are. Yes, go ahead, I'm sorry.
In the example memos, they do the tickers differently. So would you like us to do it that way?
Yeah, all right. Yeah, so some students didn't get it, like I would correct it and they just wouldn't correct it.
Right.
And that kind of drove me crazy as I go through all the memos and I make the corrections and then have them resubmit the memos with errors in it. You know, at some point it's like I can't, you know. But this is exactly the way you should do it, okay? And then for the ETFs, if you think the prices are going down, you're gonna sell short, write calls, and buy puts. And it's the same for the stocks. Sell short, write calls, buy puts. And in the memos, again, 3 times 4 is 12, 3 times 3 is 9, 5 times 3 is 15, for a total of 36 trades. Okay. Any questions on those? I'm going to talk a little bit about the derivative contracts now. Okay. And you can also go read the chapter if you want to, and you can also Google these things too to get a little bit more familiar. But this is not an investments class, and it's not an institutions class. But you should have at least some exposure to the derivatives and know how to trade them. Okay? Know how to trade them the right way. Okay? Any questions on these? Nope. Okay.
Can you explain what a forward is?
I'm gonna do it right now.
Okay.
Any questions on that? Okay. So let's talk about, we're gonna talk about forwards and futures contracts. All right. I'm gonna talk about the futures contracts first because I got the model already set up. So futures contracts are traded on an exchange, the Chicago Mercantile Exchange, the CME. These contracts are standardized contracts, basically cookie cutter, right? They have the specifications, the contract language is all the same, and they basically are standardized contracts. They're highly liquid. All businesses, if you're in agriculture or finance or anything, these are highly liquid contracts that are made available by the exchanges. They settle on a daily basis, although you're buying like a 6-month or a 9-month view out, but the securities settle every single day. So either you could be in the money or out of the money on a daily basis, but you're trading with the expectation that where do you think prices are gonna move in 9 months, 12 months, maybe 24 months out. And that's what makes the prices move, because they're looking out into the future. Okay. So here's an example. In the last class, they wanted to trade gold. Okay, and we know that gold is currently trading around $1,200 an ounce. Okay. And this could be a gold index if we wanted to trade the gold index. And there's 2 parties to the futures contract. There's actually 3 parties to the futures contract. There's the writer of the contract and there's the buyer of the contract. And the exchange is in the middle. Okay. Now there's 2 people. One person thinks that the prices are going to go down. Another person thinks that the prices are going to go up. Okay. So let's say we start the trade. Okay, so all of a sudden, spot prices are moving, futures prices are starting to move. I got a position. I think prices are going to go up. The person that I bought it from, which I don't even know because it goes through an exchange, thinks that the prices are going to go down. Okay. So if I buy the contract, I'm going to go long the prices. So if I buy the contract, I am long, and I think prices are going to go up. Okay. And if prices do, and then the other person, the writer of the contract, is going short, and they think the prices are going to go down. So if all of a sudden you start trading, and the prices go up, I make money, and the person who wrote the contract loses money. So as prices go up, every day settles, prices are higher, the strike price, I'm in the money, the person who wrote the contract has to pay me money, because they're wrong, their bet's wrong. And then the writer of the contract thinks that the prices are going to go down. And then the writer of the contract, when they write the contract, money goes into their pocket because the buyer buys it. So they think, the writer thinks that the prices are going to go down. And I think the prices are going to go up. And if the prices go down, basically I'm shoving money to the writer. Okay? I'm giving money to the writer because I think they're going up, they're actually going down. So I'm losing in my trade. So the key here, you have 2 counterparties. You have an exchange in the middle. The writer thinks the prices are going down, the buyer thinks the prices are going to go up. Okay. The problem is that on a daily basis, if I'm going long, money's going into my account. If the prices are going down, money's going out of my account. If money keeps going out of my account, I'm losing more and more money. So basically, if I bought the contract, I want to stop the bleeding, stop the bloodbath, I'm going to buy a contract, an exact contract, and I'm going to close out the position. So I went long, starting to go short. Oh, I take it back. I went long, so I bought the contract, I'm losing money, I want to write the contract. contract because I went long, and offset the position and close out the trade. If the rider thinks prices are going down and they actually go up, he or she's losing money. So to offset the written position, they are going to buy a futures contract and offset the trade and close the position. That's how they do it. You don't hold the position until the end of the period. So those are futures contracts. Forward contracts are very similar to futures contracts, but these contracts are written for years. So I'm a financial institution or a multinational corporation, and I think that prices of gold are going to go up over time. I got to go find somebody who will write the contract and take the other side of the position. The contracts don't settle on a daily basis. They settle at the end of the 2-year period. These forward contracts are called trade in the over-the-counter market, or what's called the OTC. These are custom contracts written between the two counterparties. And the individual in the middle that is coordinating this counterparty transaction is the investment bank and the securities attorney. The investment bank will negotiate the transaction between the writer and the buyer of the forward contract, and the securities attorney will write up the terms of the contract. This is a very opaque market. Both of these market values are in the hundreds of trillions of dollars in notional value. They're massive markets, but these contracts are used all the time by multinational corporations and financial institutions, and then smaller entities, speculators and investors and businesses will use the futures contracts. So the forward market is an institutional market. The futures market is more of a retail market. How much time do we have?
About a half hour.
Okay, cool. I can do the options. So does that, anybody have any questions on forwards and futures? Yes.
You won't be able to like replicate this graph on.
You know, I'll give you extra credit for it, but I wasn't making that a requirement for this. You guys want to know what it is, so I just thought I'd go through it. If you want to add those into your notes, that would be great. If you have time on the exam to do it, that's cool too. But I would just stay focused on getting through the material. Okay, I won't give you extra bonus points. Okay. Yes, sir.
You talked about leveraging helps you increase your potential gains. Can you apply leverage to forwards? And
These are
futures?
leveraged.
Those are all leveraged?
They're leveraged.
Okay.
Because let's say I have $10 million. I think the stock market's going to go up. I can buy $10 million worth of stock, right? Or I can buy $20 million worth of stock, but borrow $10 million from the brokerage house. So I bought the stock on margin, so I leveraged. Or I can take the whole $10 million and I can buy call options. Or I can buy futures contracts on the stock market indexes, because I think the prices are going to go up. Now I turn that $10 million into $100 million. So I can now control $100 million as opposed to $10 million. The problem is you gotta be right. You gotta be right on the direction. So that's why a lot of people will hire people like you to build them models, to apply the economics and the finance theory, the operations, the marketing, all that stuff. And if you're right in your forecasts, and you can apply these derivative contracts to leverage up your position because you've done the research, then the profits are gonna be huge. But if you lose, and you have positions that are going against you, you could lose a lot too. That's why you offset the positions when you see your losses coming. Okay. Did that answer your question?
Yeah.
Okay. Any other questions? No? Okay, so let's do option contracts. So you're going to buy, I think stocks are, the stock indexes are going to go up. So my Apple stock, or specifically, I think my Apple stock is gonna go up in price. And where's Apple trading right now? www.yahoo.com, finance, and the ticker, type in the name, click return, Apple stock price will come. 223. So if I enter into a call option, if I buy a call option, what direction do I think the price is going to go? Up or down?
Up.
Up. So I'm making a bet that the price of Apple stock is going to go up. So I'm going to buy a call option. When I buy a call option, are they free? Can I just enter into an option contract for free?
Unlikely.
Probably not. So I'm probably going to have to pay some premium. So I'm going to have to pay some premium. Got a dollar amount below the strike price to buy the option for my bet that I think is going to happen. And let's say that so I can buy Apple at 223, but I have to pay a premium. So basically, I have to pay money for this. So then, over time, the stock price is going to appreciate if I'm right. The stock price is going to go up enough for them to pay me back for my premium. This becomes the break-even point right here. Then if the stock price keeps going up, let's say to 323, I'm going to be in the money. This would be an in-the-money call option. And out of the money here, and in the money here. So if I exercise this option, how much did I make? What's my profit? What is it? $100. So I made a profit of $100. And I bought one call option. So that's times 100 shares. What does that come out to be? What? 10,000 bucks. Profit on it, and I had to pay 2,000 bucks premium. So what's my net profit? 8 grand. 8,000 bucks. Got it. That's how I would profit from thinking that the stock prices are going to go up. I can buy the call options. If the stock price never hits 223, like this, the whole time, at the end of the 3-month period, because they go in calendar, January, February, March, April, May, June, July, August, September, October, November, December. That's how the option contracts are sold. If the price never goes above 223, did I make any money? No. So at the end of the expiry period, the option basically expires worthless, and I lost my premium. I didn't make any money. Okay. All right. So if I think stock prices are going to go down, I can also profit. I can buy put options. still have to pay a premium. Money's going out. But as the stock price starts to fall, I start making money. And it's gotta fall enough for me to reach my break even. And then as the stock price continues to go down, I start to make money. So let's say that Apple stock crashes at 123. Falls to 123. How much did I make? How much did I make on the put option? Made $10,000. Is the loss of $100 I made times the 100 shares of the option, I made $10,000. If it cost me $2,000 to buy the put option, then I made $8,000 in a falling stock market environment. I can make money when stock prices go up, and I can make money when stock prices go down. Okay, so that's that one. Then, what I can also do, if I think stock prices are going to go up, I can buy a call option and pay the premium, or I can write a put. And since I wrote the contract, money goes into my pocket. Same thing with the put option. I can either buy the put option if I think the prices aren't going to go down, or I can write a call option. Money's going to come in. And I can make money when the prices go down by writing the call option. I can do that too. And then any questions on that? Basically, introduction to option contracts. Okay, but it should answer those questions over there. Okay. Now, what about the futures? What about calls on futures? Puts on futures? What about that? Well, this maybe is not Apple. Maybe this is some stock index. Maybe it's just a stock index. And what we're doing is we are trading futures. We're trading the options on the futures prices that are based off the stock index. Got it. So now I'm trading the options on the futures prices based on the indexes. That's why they're called derivatives. Because you're not buying a share in a company or a bond of a company. What you're doing is you're buying a contract, betting on the movements in the derivative prices that are priced off the indexes, index movements. So it's a derivative. It's a derivative contract of the underlying. And the mathematics basically works the same. Do you think that the futures price, the stock index, is going to go down? You can write a call option and you can buy a put option on the futures price. If you think the prices of these futures contracts are going to go up, since the stock indexes are going to go up, so you can be buying the call options or writing the put options. So there's a multitude of opportunities to be able to trade these asset classes without actually buying the underlying assets. You just trade the derivatives. Any questions on that? Okay. So I would probably say that after we do the technical analysis, that the hardest part of the class is over, okay? Because I'm front loading everything into the first third of the class. Unless you want to be going over this stuff the second week or third week before finals. Can you imagine doing this stuff in the middle of finals? Wouldn't that be a bummer? So we get it all out of the way up front, okay? And then you get a solid foundation to be able to cruise through the semester, okay? Without as much stress, okay? But if you can study this stuff, ask me questions, come to the review session, take good notes, review the videos, you're gonna be in a really good position and have a really solid foundation of the base fundamentals in finance. So, how much time do we have?
15 minutes.
15, 20 minutes? Okay, what else do we got? Maybe we can keep going. The technical analysis, 15 minutes, it's pretty simple. You can probably do it in 15 minutes. Can you move the camera? And then I'll do fundamental analysis. So when you're trading securities, there's two approaches. There's fundamental securities analysis and there's technical securities analysis. The book talks nothing about technical analysis, although it's used by everybody who trades and analyzes real estate, right? Analyzes securities. Okay? And it's pretty simple. There's a bunch of different theories on how to trade securities using technical analysis. The first is momentum trading. If stock prices go up, and they've been going up for a long time, where do you think they're going to go? Continue to go up? Very simple. They've been trending downward for quite some time. What direction do you think they're going to go? Probably going to continue to go down. So you're just looking at price patterns and trends. Conducting historical analysis because you're looking at price patterns going back in time from your stock charts, big charts, Yahoo Finance, whatever, white charts, whatever it is. You're going back at least 3 to 5 years. Okay. But if the stock price has been moving down considerably, you might have to extend the time period historically to find a reference point, how far it can actually go. Third is pattern recognition. Stocks move in patterns, and they repeat themselves. So technical analysis basically states, well, if the behavior of the pricing is similar to a price pattern, it's probably going to move in the same direction as the prices have done historically based on the patterns, because they're recurring. Okay. You're also, because you're going back in time, you're using time series analysis. And I can build a regression model to try to forecast where stock prices and go based on accounting factors and macro factors. I can do that too. I also want to look at trading volume. If the volume of the trading in the stock is going up, everybody's like trading their stock, well, that's either going to push the price up or push the price down. So looking at trading volumes will give you an indication of the direction of where the stock price is going to go. I can also use moving averages. And I like to use the 10-day, 30-day, and the 50-day moving average. Because if this is the 50-day, and this is the 10-day, the 10-day crosses the 50-day, and then the 30-day crosses, there's my buy signal. The 10-day moves back across the 50, and then the 30-day moves across the 50. That's going to be my sell signal. That's what we're using in my investments class, is the moving average crossover system. There's also other patterns, wedges, flags, head and shoulders. These are all pattern recognitions, techniques. You can Google them and they'll pop up. And there's also another method called the Wyckoff method, which is very sophisticated. There's also Dow theory and many other techniques that you can use to profit from stock movements and conduct the. This violates the weak form efficient market hypothesis, but people make a lot of money trading securities using these technical techniques. How am I doing on time? 10 minutes, got it. So if you go up to stockcharts.com, there'll be an indicator up here called the MACD, and then there'll be one down here called the RSI. These are basically momentum indexes. When they move up, stock prices go up. When they go down, stock prices go down. So they kind of move like this. And there's a multitude of indexes here like this. So these will give you indications. The indices, the MACDs, and the RSIs are moving up, and that means probably stock prices are going to continue to go up. So you can use those indicators to be able to forecast where stock prices are going to go based on momentum. Then in every chart, there's also going to be volume charts that will show you the amount of trades that occur on a daily basis. And when there's high volume, the stock price is going up. And when there's high volume, stock prices are probably going down. So if there's high volume, more people are buying. When there's high volume, more people are selling. And usually the stock prices aren't doing anything when there's low volume. So they usually have a volume chart too. And then the price patterns, stocks kind of look like these patterns. This. So you'll have some kind of historical price chart. I like to go back at least 3 or 5 years. Okay. So we can start reading these. Okay. So right here you can see that the stock price is bottoming, right? So this is the support line. This is the support line. And if the stock price is bottoming, boom, 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 and it doesn't break out to the downside, you know it's going to probably go up. And then this line up here, this is your resistance. This is your resistance line. And then this phase in here, this is a trading range. It's also called accumulation. It's also called a sideways pattern. And it's also called the consolidation phase. No longer stocks trade sideways like this in some kind of sideways pattern or consolidation range. It's basically just building pressure so that once the information comes to market, it's going to pop. Okay? And if it pops to the upside, this is the breakout. See, it's starting to form another support right here. You can see that could be a resistance right there. This is the peak right there. This is called the head and shoulders. This is one shoulder right here, this is the other shoulder, there's the head. This is the head and shoulders pattern that people use based on Dow theory to trade off. Then you can see it came down here, broke out to the downside. You can see the stock is in an upward trend. It now is in a downward trend. Oops. This is Yahoo. This is Yahoo. And then Yahoo got taken out. That's pretty much, that's it. That's technical analysis. It's just a quick introduction to technical analysis, because you can't study finance and stocks if you don't study some technicals. And then what we'll do is we'll come back and we'll do the fundamental analysis, which is basically the theories, the 4 valuation theories. And then that's it, we just do dollars. That's the exam. Okay, that's it. You can, awesome, thank you. So, did everybody get the schedule? Did everybody get the schedule? Awesome. And then on Thursday, we're gonna have Team 5, Team 6, Team 5, Team 6. Who's Team 5, Team 6? Awesome. And then who's Team 6? Who's doing, or Chapter 7, Risk Return? Team 7, or Team 6? Chapter 7? Okay. I'm missing a team. Chapter 6, Team 5. Right? Yep. Chapter 7, Team 6. So Team 6 is going to be over here somewhere.
We're team 7, so.
We're team 8.
Yep.
We're team 7, you're team 8. What team are they?
You're 9.
UV9.
We're chapter 9.
Okay, what does it say on the syllabus?
Share.
Something going
I got Chapter 6, Team 5 for Thursday. I got Chapter 7, Team 6 for Thursday. And there's Team 5 here. You guys are Team 7.
No, that's what
Those people say
you know,
Behind us in this row.
Yep. They're not here.
I'm not sure they all talk to class.
We could use, well, actually, didn't I just go
Hold
over
on.
risk return?
hold for a second.
If they don't show up, I'll do it.
If they're team 9, like, then we're considered team 9.
I just want to make sure, did Team 6 evaporate?
Probably.
They probably dispersed into other teams.
Huh?
They probably dispersed into other teams.
Oh, because, yeah, I'll do Chapter 7.
Okay.
Okay, but we're team 7, you're team 8.
So wait,
Let me share your chapter.
How many teammates do they have?
We have 2.
2.
Come on.
There's like there's 2 team 8s now.
Okay, why is there 2 teammates? Team 8, one of the teammates is now Team 6. You can't have 2 teammates. So what Team 8 wants to become Team 6 and take Chapter 7?
Chapter 9 is low.
Chapter 9 is like 45 slides.
Can you guys do it? I'll do it with you. Just do the homework piece. And then we can do it together. You're going to do Team 6 now. And you're going to do Chapter 7. We did a lot of the stuff. And a lot of the stuff from the presentations. Variants. And then we did that. So you can even use. Thank you. Thank you.